All right, so if nobody else has anything specific they want to talk about, I do want to mention that the new Transamerica IUL that they just sent out a flyer on. If you guys are contracted with them, you probably got it in your email today. They have a new IUL that they're coming out with, and it is FCIUL, Financial Choice IUL. It has a lot of things that are better than their current Transamerica IUL that I like, and then it has some other things that I don't like. Okay, the changes that they have to make are not good enough to put it on my radar above Allianz by any means. If we recall, our Transamerica, this is the current product, allows a 10-to-1 design split, so we can do the same 10-to-1 that we do with Allianz. It has a lower target premium, is about half the commission with that same design split at 1.1 million. You get a lower MEC limit compared to Allianz along with that, right? But the minimum premium is also lower. So there's a lot of attractive things as far as this goes from the cost standpoint. What we don't like the 0.72 charge per year. That's this 0.06 per month. That's an asset charge. The greater the cash value in your policy, the more you're going to pay for that charge. Their wash loan, for the first 10 years, 2.75. After 10, it's the wash. But they could raise it to a 3%, and you could have a permanent 1% cost instead of an actual wash loan. And then they had no participating index loan at all available. So this was like really the deal killer in the Transamerica IUL, because almost everybody I work with wants to be able to borrow their money. And it doesn't make sense if we're going to only have a wash loan that doesn't actually wash as the option. Okay, not in an IUL. We go whole life for that and we'll be happy, right? But not in an IUL. They didn't have a bonus. They didn't have uncapped index options. They only had capped S&P option, which had a fairly high cap, but you're paying for it. You're paying that 0.72 account value fee, essentially, to get that. Their load fees were the lowest out there at 4% for the life of the policy. So you could get a lot of cash value in year one. Not that you would want to borrow from it to use it, because the loan options sucked. So there was reasons why we didn't really like the Transamerica policy. The numbers are good though. If somebody wanted to get this and not touch it, if they didn't plan on borrowing from it, this could be a good one. It turns into really good cash value with the proper design. The costs are low, load fee is low. You could get a break even in an illustration in like year 2 on this thing. So like it's crazy the low cost that you could show inside of this. But it does have a 15-year surrender charge. Okay, that's the longest there is out there. And of course, some of these things can be changed, and there's that asset charge. So there were some good things about it, but there were some bad things that really make it so that it wasn't attractive to most of the people that I work with. Their new product has a minimum face amount of $250,000. The old one was $100,000. We could start doing a blend above $100,000. So just like Allianz, this one, it starts at $250,000. So you probably could do $100,000 base. It's not out. I haven't illustrated it, but you could probably do $100,000, but you'd have to have $150,000 blend in there. Although maybe it requires a $250,000 base, and then you can blend in above that. Okay. It does still allow a 10-to-1 blend. So that's good that it still allows that. But this part is kind of a knock, that you have to have $250,000. So it's not going to work for people that have a lower budget, which is where you might consider it with the other one, because the costs were so low out of the gate, low load fees, low commission. Similar as the other one, a 20-year no lapse guarantee. These are the different bandings. That just means if you have somebody that's at like the MEC limit they want needs $490,000 in death benefit, you want to bump that up to $500,000. The cost per thousand drops when you go to the different bands. So $950,000 death benefit, bump it up to $1 million. You're going to get a better price on the insurance, and it's going to be worthwhile. Same riders available. The index options, they're offering an uncapped index option. It's not a volatility index though. It's a small mid multi-factor index, which basically is an index that's tied to small and mid cap companies, which
It's higher risk though.
it
Yeah.
is higher risk. It is higher risk, but it's uncapped. Why? Those are cheaper options, right?
Yeah, that's
Small and
true.
mid-cap companies are inexpensive, so it's easy for them to go buy these options on the cheap. So that's why they're able to offer the uncapped. Okay. So it's good that they have an uncapped option. It's not necessarily a great option. I don't know how we'll have to see what the historical performance is on that, but I would be surprised if it's going to outperform like our uncapped Bloomberg and PIMCO with Allianz. Okay. They are going to give you a high participation rate also, and that's just because those options are cheap. Okay. Cheaper options means you can get more of them. That gives you a high participation rate. The plus accounts, you pay an extra cost for those. It's just like Allianz 40% bonus. So I think it's a 1% cost that they do. It'll tell us in here. They have a guarantee of 0.25%. So not much of a guarantee. It doesn't even offset the asset charge, which was 0.75. In that old product, it was a 0.75 floor. And the asset charge, the accumulation charge was 0.72 over the course of the year. So it basically offset their floor. In this one, the floor is 0.25%. So if you're using that small one, there's no charge. But if you're using the S&P one, it ends up being 1% annually. Oh, those are the plus ones. Oh, on the regular S&P index, no charge. So that's good. So they did away with that point with the account value charge, it looks like. So it looks like they did away with it with this one. So that's good. It's good that they did away with that. They did lower your floor, but hey, 0.25 floor, nothing wrong with that. There's no other bonus outside of it. So that part's not good. But they changed the load fees. So the load fees now went to 8% for the first 10 years and 5% after that. So it just got worse than Allianz. Allianz is 8% for the first 9 years, 4% every year thereafter. Okay, so these guys used to be better at 4% forever.
Did they get rid of their other product?
I
Or
don't
do they
know.
have both still?
I don't know.
Okay.
I would anticipate they'll probably have both, but you never know. They may change it completely. But you can see the guarantee is different. So they could raise it to 10% after year 10. So that's not as attractive. Not as attractive by any means when they could change it. Now the excess premium, that's just like Allianz. It's 14%. That's the load fee. For the most part, we don't deal with that. We don't have to worry about that. What that means, the excess premium means above and beyond the MEC limit. Okay.
Oh, okay. I always wondered what that is.
It's generally above and beyond the MEC limit is what's considered excess. It's not just unscheduled premiums. So don't ever think that you're going to pay 14
In a given year, or
in a given year.
if somebody, so okay, if somebody, let's say that they had, like that illustration I was working on with a 56K MEC limit, but they built it up because they only did 12K for like a decade. If they were to dump in that 300,000, that still wouldn't, like in year 10, that wouldn't be like excess premium, right?
No, I wouldn't think so. I wouldn't think so.
Okay.
It possibly could. I don't know how they'll treat
Okay.
that. The basic premium expense is applied to all premiums in the policy year until the total reaches the premium expense charge threshold, approximately twice the 7-pay premium.
Okay.
The excess premium applies to all premiums in excess. So it does sound like they could do that. If you let that MEC space build up, they could charge you on it if it's more than double that.
Yeah, I just wonder whether Allianz does that same thing and apply that.
It's a good question. I don't know because I haven't let that much MEC space build. But if it does,
yeah, because that could be like
so like it's probably in general something I tend to ignore the load fees anyways, unless they're just too excessive. But in this scenario, you would have to decide if you're trying to dump in, hundreds of thousands of dollars, it might be worth it to get it into this nice, safe environment, knowing it's a one-time cost. And then you also have experience on what the policy performance is. So you know how quickly you might make back that 14%.
Oh yeah, no, I mean I think it's overall still fine, but I think I want to know for if I recommend this to folks who might want to build up some of that mech space, and you know, really on the Allianz side, because I like, you know, that
Right.
I think looking at this, I still like Allianz better, but
Well,
you know, whether or not that's might apply if
when we
somebody.
had asked them about it, they said it was money above and beyond the mech. So they didn't define it like this. I haven't seen anything in Allianz that gives it a definition like this. Okay, so
Okay.
I'm not familiar with how they're going to treat it exactly. Okay, so back to this one. Their per unit charge is also, that's where they recoup the expenses. So the higher the commissions, the higher that per unit charge is. They have a persistency credit, which is after policy year 10, 0.6% on unloaned values. Okay. Not available if the policy is lapsed and is reinstated. Their policy fee, so like with Allianz, we pay $90 for the year. These guys, it's $10 a month, but they could raise it to 12. So it's either 120 or 144. The loans, they started offering an index loan. Yay. So that was one of the good things that I noticed in this. The not so good thing is it's a non-guaranteed 5%. It could go up to 8%. I don't like 8% possible loans in a participating index loan in an IUL, because the odds of us getting a higher than 8% return are not great.
Yeah.
Right. So the opportunity for arbitrage is really hampered if you're anywhere near that 8%. I feel way more comfortable knowing it's never going to go over 5%.
Yeah.
Okay. And when you think about it, it shouldn't go over 5%. How they do their business. So with Allianz, they take 5%. They allocate 5% of the premiums is what they use to go buy the options. There's no reason for them to charge 8%. They don't need to. It doesn't cost them anymore to charge you to have you pay that 5% that they go buy the options with, as opposed to them just paying that 5% to go buy the options with. Like, it doesn't matter. It should be a wash. I don't know why you would need to raise it to 8% unless they're going to do that to recoup losses that they're experiencing elsewhere. Okay.
And James says it's available only after the 5th year.
Yeah, that's true also. You don't get the index loan available right away. So you can't do it in the first 5 years. I think it's year 6. Was it year 5? Available starting in policy year 6. Yeah, so I mean, it's good that they're offering that, but it's not a great option if you have to wait 6 years to be able to get that index loan. So some good things about it, but it's good to know these things because you're going to encounter it. Your clients are going to get some illustrations based on it, and you're going to want to know how to talk to them about it. Okay. I may put this part out on a video as like first look at the Transamerica.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.